Everyone's talking about it. In the USA, the usual 30-year mortgage rate has just gone over 7.6%. That's the highest since December 1st, 2000. Looking at it this way, things are pretty bad. People are wondering how the market can stay stable with this going on. What was just a small bother has grown into a huge problem in the world of finance. It's a tale that tells us about what might happen next and shows big worries for what's ahead in our shaky economy. The coming housing crash looks like it'll be the worst we've ever seen. To understand why, let's look back at history and see the clear signs that what's happening now is not normal. When folks show you a chart of house prices over time, there's a big problem with it. It doesn't think about inflation. For example, buying a house in 2000 for $200,000 seems good, but with inflation, that's like spending about $356,000 now in 2023. So it's not really a profit. To really see if there's a bubble, we need to look at prices with inflation in mind. There's a thing called the inflation-adjusted Case-Shiller that does this. It shows us real house prices, taking out the confusion of a weaker dollar, and you can see we're now past the last big bubble, a huge event in U.S. history. Thanks to researchers like Robert J. Shiller and Carly Case, we have good data on house prices going way back to 1889. The 2008 prices were crazy high, something we thought couldn't happen. Even though house prices have been going up for the last 100 years, what's happening now is even bigger than 2008. Things used to be normal until around 2012, but not anymore. So why do I think we're going back to those times? It starts with some history. The 2008 bubble growing after 2000 wasn't a shock. It was because of interest rates. Long ago, interest rates were much higher than now. For 30 years, they've been getting lower. This set up the 2008 bubble to grow and then burst. But we didn't really learn from that. After 2008, the Federal Reserve kept making interest rates even lower, down to 2.6% at one point. And so, a new bubble started growing from 2011 until now. The real price of houses, considering inflation, went up 66% apart from the 2008 increase. We've never seen such fast growth before, and usually, a crash follows to bring things back to normal. If you're not convinced by this, there's more proof that shows a big change is coming. The housing market is really affected by interest rates. Most people buying houses use loans like the 30-year fixed mortgage. This kind of loan is linked to the 10-year Treasury. Basically, this decides what mortgage rates will be like. So, what does this mean for house values? Well, let's put it simply. Think of a 10-year Treasury note as special paper the government uses to borrow money. They promise to pay back the money with a bit of extra interest after 10 years. Right now, they offer 4.5% interest. But here's something interesting. There's a 2-year Treasury note too, and its interest rate is 5.02%. This means they give more interest for borrowing money for just 2 years instead of 10. Usually, it's the other way around. Longer loans have higher rates. When it's flipped like this, we get what's called an inverted yield curve. This is a big sign of a coming recession. Looking at a chart from the late 70s, every time the rates flipped, a recession followed. This happened in the early 80s, 90s, 2000s, 2008, 2020, and it's happening now. The chart from 2022 doesn't show the latest, but we've gone deeper into this flip and are now starting to come out of it. You might think that's good news, like we're avoiding trouble, but actually, the worst part usually starts after the flip is over and things go back to normal. Remember 2008? The real trouble came years after the flip. Right now, things look really bad. The Federal Reserve is raising rates a lot, but the bond market doesn't seem to believe it. This leads to my final point about a possible crash. For instance, the interest on 30-year loans is almost the same as for 10-year loans. This suggests that people think there will be more inflation soon. Everyone would choose a 30-year loan if the rate was good. But with so much uncertainty, the 10-year loan looks better, even though the rate should be lower than the 30-year loan. Basically, people think inflation will stay high because of what these rates are showing. If that's true, the Federal Reserve needs to raise rates to control inflation. But for inflation to come back strong, the Federal Reserve would have to give in. And for that to happen, there needs to be a big crisis. And that crisis is already here. It's the potential total collapse of the housing market because of these rates. Rates work like gravity, pulling us into unknown places. Before we finish, let's think about how this housing market crash will impact homeowners and investors. It's not just about higher rates and possible economic troubles. It's a big deal for everyday people and smart property investors. Homeowners, especially those with adjustable rate mortgages or those looking to refinance, will struggle with higher payments each month. This could lead to more people losing their homes and lots of cheap houses for sale. Investors who thought house prices would keep going up will face problems as values drop. They could end up with houses worth less than they owe and get less money from renting them out. Don't forget to subscribe to the channel for more investment insights like these.